Good morning. I'll wait until people stream in. Hello, Ariette, Jennifer. I hope you're doing well. Having some difficulties with my iPad, not sure why. So let me know on your end if you see anything problematic. I have my phone beside me. You can text me. If I'm not reading the chat, I will see my texts. So as I promised, I'm going to fill in the gap that I left on the portfolio theory. So you have that information. And it is from here, about here, that I'm going to include the material for the final test. We agreed the final test would be on the Saturday. This will be an algorithmic test in Connect. So it's different from the other tests I've given you, but I need one test with a standard of time and proctoring. Okay, that's how I feel. So that will be on Saturday the 20th, like we agreed. Some people have asked me for a different day, a different time. Not many, but I like to do it all at the same time, on the same day. So if anybody has any issues with that, they can let me know. At the beginning of the test, I'm going to ask you to put your student ID up invisible so I can see it and I can validate it with you, with your appearance, and then I'll start the test at the same time with everyone. That is my plan. All right, so maybe we'll do a test. We'll do some sort of test. Whoever wants to opt in to make sure everything's running smoothly, I'll set up a test proctor at some point in the week before to make sure everything's working. So like I mentioned that the test will be just from this material on, okay? So it's just the last piece, but it is a culmination of everything, so I think it's sufficient for a final test. I believe we settled on the Saturday. And the Saturday is the 19th. I think it was confusing. Anyway, you guys can tell me, remind me, what did I say? I can look it up. Okay, what did we agree? Saturday, December 19. That's what I said. I'll put it in the chat. Morning. Oops. Shouldn't have a question mark. Okay. So this is page 22 of the notes. And what I want to do is discuss the origin of the security market line, and I'll help you understand better where it comes from. So in the pages before, I mentioned beta and calculating beta. What is beta? The interpretation. And then in summary, we saw that combining stocks into portfolios can reduce standard deviation. It's the covariance or the correlation coefficient that makes this possible. And just here is an alternative formula. One moment. My video isn't updating. Not sure why. Hold on. What is happening? One moment. Oh, I see. There. Okay. So, this is just what I read. So this is the standard deviation formula. And depending on what you have, if you have the covariance, you can put it in there, or we can make an alternate formula where instead we have the correlation, which is the standardized covariance, and this would be the substitution in that formula. So this formula is very important for calculating risk, right, in a portfolio. So looking at that here, what I've done is presented an example, because what we're going to try and do is pick the best set or the best pair or the best mix, that's the best way to say it, the best mix of assets. All right. And so what I've done is I have put together a portfolio let me see. Yeah. 1 minute. We're going to put a portfolio together with two assets. This is page 21. So we're going to call them Y and Z. And here are their standard deviation and expected return. So these are the expected return and standard deviation for both. If I was to blend those together or put them together in a portfolio, the formula for calculating the new expected return would be the weighted average. And the formula for calculating the standard deviation of the portfolio is this weighted average or weighted standard deviation. And so what I've done here is just left out what weight I should put on each asset. Is that all right? So I haven't put it in. And then I've done the same thing here where it's a more general formula. So the question becomes, what is the best combination of assets for the portfolio? Okay, so remembering that risk and return has a trade-off, keeping that rule in mind, and that investors like return but dislike risk, so we need to find a happy point or a minimum risk point after which we can use our preferences to make decisions. That's what's going on here. So everybody's with me so far? So this is just the expected return formula with an arbitrary set of weights, and I've done the same thing here. And what I'm going to try and do is come up with a general rule. I'm just looking at the question. When you have the grades, well, I don't know, like the grader is working at it, and I did tell some other students, some students complain as they're not getting their grades, but I'm not giving you multiple choice tests. You have those in Connect to see your answers. This evaluation is informative, and yes, I think you want more than the grade. I hope you want more than the grade. You want to see how you did. So I will send you the solutions for the last two tests, and hopefully the grader will have those results. I'm surprised I haven't heard from him. I guess he was busy with his own work. But I talked to him last week, and I thought he'd have them by now, but he doesn't. So I will put pressure to get those back from him. But in the meantime, I'll send you the solutions so you can study, all right? I'll send them this weekend. There's a lot of work. It's not a normal time. The amount of work I'm dealing with is, I don't want to complain. It's probably as stressful as yours. So just imagine we're all going through same stress, and I'll do my best to get you at least those answers and the grades as soon as possible. Okay, so back to this. So what we're going to do next is look at some options. Now there's an infinite array of possible combinations, right? Because I could put different weights. So here's just 3 combinations. So here are portfolio 1, which has more of Y in it, portfolio 2 that has an even mix, and portfolio 3 that has more of Z in it. Now going back for a moment, sorry I'm switching so much. The higher risk portfolio is with a higher return is Y, and Z is lower risk, lower return. So the more Y in it, the more risky. That's how you look at that. So here you have the more Y in it, the more risky. So number 1 is more risky. Expected return is higher. And depending on, I've also left out not only the weights, but I also left out the correlation coefficient. So the correlation between the assets. So I can show you, I can identify a pattern to show you. All right. So these are the alternatives. The assets are perfectly positively correlated, perfectly negative correlated, or not correlated at all. And you see the one with the most risk, the highest standard deviation of the portfolio is that where they're positively correlated, right? There's no diversification effect. And so this is going to be the highest, and it should be all the way down. So let's look at the second portfolio. Let me ask you if you understood what I just said. Okay, I'll look into Connect what the issue is, okay? I don't know. Depending how I set it up, I may have hidden the results until the due date. So you might be waiting for that until the due date. But I'll double check what's going on. Okay, so no questions about this so far? So the second portfolio is where they're evenly included. Like so what do these weights mean? Let's say again, if I invested $1,000 into this portfolio, that means I'm going to split it 500 in Y and 500 in Z. That's what that means, okay? All right, so for the second one, this is less Y, so less risky, then less return than before. And then also considering the extremes, perfect positive correlation, perfect negative correlation. So this, again, is going to have the highest risk or standard deviation measure. So let me just make a mark to remind you this is like the highest all the time, right? So the next one is a mix of, has the least risk, right? Because you have the least Y in it. And so that's going to be relatively low. It's half of the first one. And And even when you start looking at the diversification effect of perfect negative correlation, one hedging against the other, then you know, this is the lowest you can get of all. Okay, so the less risky portfolio, it's made up of more of the less risky portfolio. If they're perfectly negatively correlated, this is the lowest risk possible. Okay, so these are not things you choose. All you're going to choose are, if you were to do this, this is what you choose. You choose the weights. Okay, this is just saying, what if this, and what if, what are the parameter, what if the parameter changes, the parameter being the correlation between them. Okay, so this creates, if you were to sit and plot those three sets of portfolios and imagine what's in between, because it's a weighted average, it's going to create a linear combination of possibilities. These are all the possibilities here and along here for the case where the portfolio has assets that are perfectly negatively correlated. And on the other extreme, you just have a straight line. There's no diversification effect. This is the diversification effect here, you see? Because adding more, so I plot Z. This is less risk, less return. So 1.2 and 14.4. So actually this is the expected return on this axis, right? So this is return and this is risk over here. I can move that up a bit. And here what you see is adding more. So I'm here, if I start with Z, this is 100% Z, 100%, all Z. Okay, and over here you have 100% Y. So you have its standard deviation and expected return. That's why. And what you see is the more of Y you mix with Z, the risk goes down to here. And beyond this point, adding more, even more of Y in it becomes more risky. Now, why does this happen? Because they're perfectly negatively correlated. The benefit of adding more of Y is reducing the risk and increasing the return. But after this point, adding even more of Y increases the risk, but you see it also increases the return. So what is happening is this diversification effect here rules out all these possible portfolios, okay? Because why would an investor choose he wouldn't stop adding Y as long as his return increased and his risk decreased. That's exactly what he wants to do. But beyond this inefficient set of options, at this point, what we call the minimum variance portfolio or minimum standard deviation, but they say minimum variance. Beyond this point, it's up to an individual's preference for a risk tolerance that a combination is chosen. So you guys, let me continue and then maybe this will sink in if you didn't get that. The other pattern to see is what if they're perfectly positively correlated, and that's the lower set of combinations here, okay? There's no diversification effect because the returns don't offset each other. If you have negative returns of one, the other one also has negative returns. If you have positive returns of one, you also have positive returns of the other. So there are no set of assets combining the less risky low return one with a risky one continually adds more risk and more return or higher return. And in between those two is the case where there's no correlation between the two, and adding to the low risk, low return asset more of the risky one, you experience a higher expected return without adding risk to a point, and then the risk and the return both improve. So what we want to know about is the mix. We want to find the mix of portfolios that will give us the highest return until there's a trade-off, and then we have to use a different tool to decide which one to pick of all of these. So all this does is map out 3 scenarios showing you the boundaries for your choice of mixing assets in a portfolio is somewhere in between these bounds. Okay? So questions, if you guys can formulate one at this point. If not, you can ask me later. So just reiterating, if I ask you to draw this, you plot the low risk, low return one here, the high risk, high return one here. This would be the upper bound. If they were perfectly negatively correlated, this would be the lower bound if they are perfectly positively correlated. And if they're anywhere in between, you get a certain shape. And I've just plotted here the example if they're not correlated at all. So given the information, you're not going to plot all these. These are just showing you the boundaries, okay? This is a general case. What you really end up with is something like this. Somewhere in between, okay? Somewhere in between. So this drawing here, this sketch, represents the possible combinations from which an investor can choose. Well, right now, this is all the possible combinations, and the efficient ones are those beyond the minimum variance portfolio. So these are inefficient up to here. Or they're infeasible. They wouldn't exist because any investor who knows how, let me write that. Let's see, infeasible is a better term because they won't exist. It's infeasible word, infeasible, unfeasible, non-feasible. I'll write not feasible, sorry. Okay. Okay, so you have the pattern. It's similar to the SML, right? Where you have return here and risk here, but rather than using beta yet, I'm just going to use the standard deviation of the portfolio and its expected return. Questions so far? So this is saying anything in between the extremes makes an eggshell shape. That's what they call it. Or this curve. Oops. All right, so here's a summary. Okay, so from Z, right, okay, so we're going to call these from Z, no, sorry, feasible, CY. Okay, so they call it Z to Y are feasible set. Okay, well, I guess that contradicts what I just said. So the infeasible ones that I mentioned down here, the efficient set goes from MV, the minimum variance portfolio, to Y. And they're referring to these all as being feasible. I guess let me correct myself. I'll stick with the vocabulary and call this, no, I'm just going to say it doesn't exist and to avoid all this. Sure, you could create a portfolio rational investors, which is in theory, in this theory that we're using, is what we consider. Rational investors will not select any of these combinations, or I'll say portfolios. Okay, and so although you could construct feasibly any of these will fail to exist, so we will call from here to here the efficient set. Okay, so this is the efficient set from here to here. However, it's possible or feasible to create any of these. However, in a rational investor wouldn't pick these down here. All right, let me continue. So all we've done is talked about two assets at a time. Each half eggshell represents the possible weighted combinations for two assets. But as we discussed, in a portfolio, you hold more than two assets, right? So how do we combine them? So this is a way that's used to explain this. You want to pick a combination of all available assets which gives you the highest return with a acceptable level of risk. Notice, I want to point out, when I draw this curve, or this curve, or this one, I'm not hitting the axis, right? When does it hit the axis? When is it possible for a portfolio to have zero risk? Just before I continue, what did we just learn on the other pages? Right? But in terms of a portfolio and what we're looking at, we could get here if the correlation was perfectly negative. Okay, so that's a boundary. That's an extreme case where assets are perfectly negatively correlated. You could diversify away completely all the risk. Sorry, I'm jumping. We know this is the diversification effect. This backward bending. So that's also a minimum variance portfolio for that alternative. So this is the MVP, this is the MVP, okay? So in answer to my own question, this will be possible when correlation is negative, perfectly negative, 1, and when we are using the weights of the minimum variance portfolio for that set of assets. Now this one doesn't go all the way back, right? Because I'm implying this is just a general case, somewhere in between those extremes of perfect negative correlation and perfect positive correlation. Okay, so continuing with the eggshells, half eggshells. What I'm doing now is showing you 2 assets at a time, and then another 2 assets at a time, and then another 2 assets at a time. And demonstrating using the same logic, we want low risk. So we want to move in that direction, but we also want high return. So looking at all the alternatives, it forces us over and up to this envelope of possibilities. We're still in the same space of risk and return, but we want to be outside here where we're now these are all overlapping, okay? Even though I've drawn it like this, these could potentially overlap. And it's one of these, again using the same logic, no investor would pick. even though they could create some of these, it would be irrational to pick any of these. So they would start here with the minimum variance portfolio of combinations of all the possible assets to the more high risk, high return assets. So some combination along here, known as the efficient frontier, is where they will choose a portfolio. So the composite of all asset sets, or this envelope, and in particular the segment MV to U, constitute the efficient frontier. We call the feasible set because we could create any of these assets, combination of assets inside or along here. They are all feasible, but in the end, investors choose along here. Questions? Hello, Mario. So we assume investors are rational, they prefer more to less, and they're risk averse. And that is how we see their movement will be in this general upper left direction. Their choice will be among these portfolios. Okay, so which asset dominates? I'll send you some examples or some exercises on this, or I think I did already. If it's the same logic, but let's work through it for people who are still trying to understand. Let's say that's a combination, so that's a portfolio there. And this is a portfolio. Which one would you prefer, A or B? It's clear, right? It's a clear choice. So we say A dominates B. Okay, so the portfolio A dominates B. Now I'm going to show you a different one. Does C dominate anything? Can I write a similar expression about C? C does not dominate A or B. Okay, let's make a D. What if there's this over here? I have a call. Hold on. Just gonna know. So what about D? What does D do? What does D dominate? I'm just talking about dominating. And I'm not talking about risk-taking investors right now. I'm just talking about rational investors. That they like more return and less risk. I'm dealing with the movement. Okay? Left and up. D dominates A because it's up and to the left. So I'll show you, this is how I would do this in general so I can continue on. I would just basically draw this axis right through D. And D is up and to the left of every one of them. So it dominates A, B, and C. Is that because it's up and to the left of A, B, and C. Okay? That's how you do it. So I'm trying to show that it's in the lower quadrant. Okay, no questions? I continue. All right, so we are left with these options now, these alternative combinations, and we want to be able to pick one. So we introduce, and what we're picking, because we've included all assets are included, what we're trying to find right now is the market portfolio. Okay, so what we're searching for is the market portfolio. So it has all assets possible in there. So all risky securities are in there in some proportion, but some will have a proportion of 0 because you're not invested in them. So what we have is a set of risky assets. Let's introduce the riskless asset now. So that market portfolio is what we're looking for. And we're going to introduce the riskless asset. To do that, I'm going to discuss momentarily, or I'm going to discuss the concept of short selling, which I did discuss or introduce the last class. But let's make it more explicit. What is shorting? More clear. Short selling is the sale of security that an investor does not own. How do they achieve this? The investor borrows the security from a broker and then sells the security and takes the proceeds and uses it however they wish, with the notion that they will turn around and have to buy the security back and return it to their broker at a later date. At the initiation of the short sell, your only cash flow is the proceeds from selling the security. In closing the short, eventually you will have to buy the security back in the open market and return it to the broker intact, right? Like the security, you're giving it back. In the interim, in between that time, hopefully, you realized a profit because either you're able to do something with those proceeds to profit relative to having to buy that security back and return it. Another thing that could happen is that the price of the security you have to return falls or drops. And you can take advantage because in the interim, whatever you borrowed, you don't have to pay it all back. I mean, whatever the value of the security that you borrowed, that you sold on the market, is going to be, the value will have gone down over time and you don't have to return as much money. So shorting is done when you believe the value of a company and its stock will drop for whatever reason, and you find somebody on the other side of that deal that's willing to, or like a broker who's willing to make that deal with you. So he obviously thinks differently. He thinks the opposite. Okay, so what is the cash flow? At the elimination of the short, your only cash flow is the price you have to pay for the security in the open market. So let's use an example where the security that we're going to short sell is a T-bill. So here is a Treasury Bill, which is a bond, right? And it's zero coupon bond issued by the government with a face value of $100 and a maturity no longer than 1 year. So we're just going to use 1 year. After 1 year, the T-bill yield is 5%. So that means that if it's going to have a face value of 100 in a year, then you should have been able to buy it for $95.24. Everyone okay with that? This is the basic time value of money formula being applied here. So this is the price, this is the face value or the return at the end. So this is an implicit 5% yield. So with the short sell, you borrow the 1 year T-bill and you can sell it for $95.24. So there's no, we assume that that zero transactions cost when we do this. So we didn't have to pay the broker anything. We have this deal, we borrow it, and then we return it. The cash flow would be the proceeds we get from selling it for $95.24, what it's currently worth. And then at the end of the year, you have to buy it back to return it to the broker. So you have to buy it for $100. So you're going to buy it back for $100. So the cash flow at the end is the price you have to pay for the T-bill in the open market. This is known as risk-free borrowing. This transaction is equivalent to borrowing $95.24 for 1 year and paying it back with 5% interest. And the idea would be that in the interim, you're going to use that money towards other investments. So we've introduced risk-free borrowing, but at the same time, we can also discuss risk-free lending, and I'll discuss that too. this creates here's our eggshell, half eggshell shape, imagining creating all the combinations. And what we're going to do now is introduce the risk-free asset, which will appear here. Okay, so also here on this line, you'd mentioned to me that T-bills are here, right? No risk. And if an investor is here, they're just investing in T-bills. If an investor is here, they're just investing in the market portfolio. You can only be in one place at a time, okay? So either you could be here, you could be here, or you could be at some combination of the two, mixing your market portfolio, which is a combination of risky assets that is determined as the portfolio that is tangent to this line. This line is the line of a linear combination or mixing the risky and the risk-free asset. And we talked about rational investors should also always hold the risk-free asset, right? So at least beat inflation. Oops, what happened? And this is the combination of risky assets that they will choose because of this line being perfectly tangential. So this is the best combination of all the other possibilities to mix with the risk-free asset. So between here and here is some combination of the market portfolio and the risk-free asset, where risk-free lending takes place, because when you buy a T-bill, you're basically lending money. So anything in here where I've marked A, so any of these would be A, creates a portfolio that invests in lending money and the market portfolio. Any asset beyond this, where you have higher risk yet higher return, can be created by doing the opposite with the T-bill, borrowing through short selling, as I described. So you're taking those proceeds, right? So you borrow the T-bill, you sell it and use the proceeds towards investment in the market portfolio, and you expand the possible returns beyond the market portfolio. All right, so that creates what's called the capital market line, mixing the market risky assets in the market portfolio with the risk-free. And what we do then is from there, we derive the capital asset pricing model and the security market line, where our measure of risk becomes a beta. So just to wrap up, all securities are in the market portfolio. All investors will have the market portfolio, in their portfolio, since they are all on the new efficient frontier of the capital market line, investing in both riskless and risky assets. Okay, so investors are only concerned with the expected return to market portfolio and the risk of the market portfolio measured by the standard deviation, and with the contribution of each security to the market portfolio in terms of its contribution to systematic risk measured by beta. And from there, we move to the capital asset pricing model, because we're interested in the expected return that adjusts for level of risk. Okay, so I've taken an hour just to fill in that gap, and I did give you some questions. Or you already saw the exercises for this. I sent them to you, and now you should try some of those exercises. I think I can give you, or gave you some more. I'm trying to think. If I gave you exactly portfolio questions, I'll go over what I gave you and give you some more questions on the portfolios and mixing assets in a portfolio and the minimum variance portfolio for practice. Okay? So that is that. Any questions? That's the Markowitz portfolio theory. And I also gave you this handout on the UR case part 2. So whatever's in here is covered in the notes that we're going to discuss next, so you can go back here if you haven't read it already. This is what we intend to do. Oh, not the Canadians, I'm going to say the US. But I'm showing you notes from I can't seem to open my folder with your exact notes, so I'm showing you anyway, the headings might be a little bit different because I use these in a Canadian course. All right, so anyway, you have the UR case, the right one. So what I want to do now is the last set of notes for CAPM. Oh, I can't give you this. Give me a moment because I need to figure this out. Why I can't open your folder, because this is not going to work. The numbers are all different. I don't know. I can't figure out. Okay, give me a moment, okay? Take a 5-minute break. Okay, I'm back. I am back. So these notes are solving your case that I gave you in document 5.8. All right, so I have here the capital asset pricing model and the beta expressed as, it looks a little slightly different. It's the same formula, just with small r's, emphasizing that what we're really getting at is the cost of equity. Okay, so little r like for the interest or required rate of return. So this is the expected return using the capital asset pricing model for this level of risk. This is the equity beta. So this is the beta of the stock in the company, which is determined by taking, so you can make all these calculations yourself using the information I give you. This is the company itself, UAIR, right? So this is on the y-axis, and this is the market, so that's on the x-axis. And you can calculate the covariance and the variance. The covariance of market with the UAIR and the variance of the market returns. Okay, that gives you the beta. So that's one of the formulas of beta that we have. So you only have to calculate two things to get the beta, or you can just put this in your calculator and get it very quickly. Okay, so remember how to do that. So here I write it all down in columns, like I emphasized to do. This is historical data, so you don't have to do, there's no weights here. It's just this formula for historical data where you divide by n-1. Or like I said, you just put it in your calculator and you get the results. So if you put these in your calculator, you should get the beta of 1.55. And unless you're doing this in Excel, I say you can round to, yeah. All right, so everybody's okay with me with this so far? So we've calculated the correlation between the market returns and UAIR, the variance of the market returns, and then the beta. So all these symbols are just the symbols that I used or shown you that are being used for historical data. So given the information, you have information on the ex-post 90-day T-bill rate over the same time period, 2005 to 2010. So if you calculated the average T-bill rate, would be 2.365, so you could just get this out of your calculator, and the average market return which was 5.11 from before, right? Did I put it there? Oh, it's up here, sorry. So that was the market return, 5.11. So these are just averages, historical data. And so that's from before, that's from here. So you could calculate the average historical market risk premium, so just over this period of time, as 2.753. Now, having said all of that, using the historical data, in this exercise, I suggest that you still use the current T-bill rate in the CAPM formula. Even though I didn't use the T-bill rate of 1%. Here I use historical. So this is done because it's recommended to use the historical market risk premium for adjustment. But you want to consider in your formula the current T-bill rate. All right, so these are different approaches. These are, you're going to see I'm going to do this, I'm going to make this calculation a couple of times, and you just have to be wary of the assumptions. And if I was to ask you to do this on your own, I'll give you direction, right, of what data to use and how to use it. So if you do get historical data and you see the average T-bill rate of 2.365, sorry, the average, T-bill rate of 2.365 is different from the current one, you need to use the current one here. So that's 1%, and then this adjustment for risk using the historical market risk premium and the historical T-bill rate. I hope you understand what I'm distinguishing here. All right. So what we've done is calculated the required rate of return using the CAPM for UAIR. So using the information given so far, the required rate of return should be 5.27%. Given the level of risk in UAIR, which was using a beta of 1.55, this is the required rate of return, according to CAPM. So that's one CAPM. That's one R, one required rate of return. Or we call this the cost of equity, right? So it's the required rate of return. It's the cost of equity, because I've only considered stock. What if I used a broader, a greater or larger set of historical data? If I do that, then over 1928 to 2010, the average T-bill rate was 3.7. If you go back to the notes. And the average return to common stock was 11.3. So the average historical market risk premium, so this will change things, right? So this would make the average historical market risk premium over that period actually 7.6%. Using the current T-bill rate, this will give you a different required rate of return. It's higher. So it's double, right? It's double of what we had before. So it's very different if you use just the last 6 years or those 6 years of T-bill data. This required rate of return makes it less likely the project will be accepted. So when they're so different, the recommendation is to use the more current data for a more reliable estimate of cost of equity. So they're quite different given your assumptions and what you use. So just follow the directions I give you, and you'll get the right answer. But then in considering things in the broader scheme, which one to pick, you'll have to consider what's been done in the industry and what has been done by your predecessors. Okay, what have people done in the past? All right. Questions? Are you talking about, on your question, if I put the average T-bill rate here, I should always use the current T-bill rate here. The time period over which you calculate the historical market risk premium will determine your results, and then you have to decide if you're going to use the more current data as more meaningful or something over a longer period of time as more, if you believe for some reason that in the future that returns will follow historical trends, or if you think it's going to follow more current trends. That's the question you have to answer. So yeah. So you always put the T-bill here, current T-bill rate here. So even though I have the same symbol here, unfortunately, this is using a different, RF. So be careful, okay? All right, so we've done this two ways so far. So I did this, calculated the cost of equity or the required rate of return for the firm, UR, using the last 6 years of data, relevant to this question, these last 6 years. I also did it using all the history I have on the stock market. So for the average return and the average historical market risk premium, I have an answer that's double, and I decided I'm going to stick with the 5% figure. And now there's a third way to do this, where I'm going to use the dividend growth model, and I'm going to refer to it as DGM. And using the dividend growth model, you guys can review the math here, but what I've done is remembering our formula. This is the formula that we typically use, assuming constant growth, and the first cash flow is C1. I can rearrange that formula and use it to calculate the implicit rate of interest or the required rate of return or the cost of equity, which all mean the same thing. So I'm going to use this, which is something we learned in the first couple of classes. Seeing the first cash flow as the dividend next period. So 1 period from now. This is the price today. And for G, I use the implicit growth rate. And even though there's a different G between here, I use the average growth rate. Okay, so there are, it's not the same G, but you see we make an assumption that it's the same growth rate to use this formula. So I find the average growth rate, the geometric average growth rate. And there it is. I put it in there. And you see what I get. So you guys work on that calculation, okay? I'm not going to do that right now in class because it takes too much time. But step through that calculation, and what you will find is a number similar to what we got using the last 6 years of data. Okay, so this approach using the dividend growth model gives us a similar number for the required rate of return. So 6%. It's a little bit higher. It's a little more, more stringent. It will require a higher rate of return to accept projects. All right, so we are going to stick with the original one, the CAPM. Even though I've shown you 3 different ways, I'm going to stick with the CAPM from the first approach, where I use the last 6 years of returns data for the market and the average historical market risk premium over those 6 years. And here's the information I'm going to pull from what we did with the UAir Bahamas project. So here are the cash flows that we determined together. And when I take those cash flows, I can figure out the internal rate of return, which we did. And I get 10.26%. What does it mean? Well, it's high enough, right? The internal rate of return exceeds the required rate of return of 5.27, so we should invest. If we use the more stringent, the historical market risk premium over the 80-some year period, we would have rejected the project. So it's sensitive to which CAPM or which assumptions you use. Okay, so that's the main emphasis here. Making all these calculations you can practice to make sure you can get this, right, to review. But essentially that's the comparison you make. Alternatively, you could calculate the NPV and it'll give you the same conclusion, but then you can see the return in terms of present value future cash flows is 6,000. So it's worth investing in the project. It's giving you the same conclusion. Let me just make a note here in case you're a little bit confused. If this was true, then you would not invest. So it's really important, the assumptions that you make in making your calculations for the required rate of return. So I'm going to plot now into my risk and return space with the asset. Notice I put the asset here and the beta of the asset. It's the firm UAir, and it ends up here off the security market line. So for this level of risk, you get this massive return. So you should invest in this. Okay. So this was for, all we've done is assumed, or we've used the information about equity, the UAir stock returns, the UAir beta to compute the expected return for the firm. But what if the firm was not only a stock issuing firm? It didn't just finance with revenues from the sale of stock, or rather it would also be financed by debt issue. Okay, so the borrowing money. Well, from the balance sheet,
If a firm is not all equity financed, we need to consider the effect of debt. We're going to use the notation. This is a standard notation. Equity is S and debt is B. And in terms of the balance sheet, the firm's assets are equal to debt plus equity. So this represents, V represents the value of the firm or the market value of assets. So S is shareholders' equity and B is outstanding debt, total value. So just to be clear on some notation, S is the market value of outstanding stock, and RS is the return on equity, or we call it the cost of equity. And the beta of S is the systematic risk of equity. So similarly, B is the market value of outstanding debt. So that's all the bonds outstanding times their price. So the number of bonds times their price. This is the return to bonds, known as the cost of debt. And beta of V is the risk of debt. Okay, so these are so the risk and return measures carry over to or are paralleled in terms of debt. So we're going to look at this from two perspectives to get through this. One is we're going to look at things from the firm's perspective, and on the other side, we're going to think of things as from the investor's perspective. And the investors there's three types of investors. There's the investor who's a stockholder, there's the investor who's a bondholder, and then there's an investor we're going to talk about the average investor in the firm. And I'm going to define that clearly. That average investor is partly invested by owning stock and partly invested by owning debt. And they do so in the same proportion that the firm has issued stock and debt. Okay, so that is what an average investor in the firm is. So I'll get into that in a bit. Let me see the questions. Yes, for your question about which method to use, I'll say, well, maybe I will just say just solve this, and then I'll accept IRR or NPV, or I'll ask you directly to use IRR in your calculation and make your decision, or NPV. Okay, so yes, you'll be directed. And if not, you just text me during the test if you really need to, but I'll be as clear as possible in the questions for the final test. And if I'm not clear, I will consider that when I'm grading. Okay? You can complain. I shouldn't use that word. You can let me know. All right. All right, so now we have the V as the market value of assets of the firm. The return to assets is known as the return to the average investor in a levered firm. Levered is a firm with debt. Okay, so this term here, if you didn't know. So it's like it depends on, or I don't know, levered.
leverage gives you greater possibilities. Okay, so that's why we call this a levered firm when there's debt as well as equity. So the return to the average investor in the levered firm is return to assets. And the beta of assets is the systematic risk of a levered firm. All right, so just to get through the notation, bear with me. It looks repetitive, but it's really helpful that you know this. So where we're heading with this is the WACC, which you all should have learned about, but I'm painstakingly going to go through this with great detail. Okay, so S is the market value of outstanding stock, and the return to equity, or cost of equity, is the return to shareholders. B is the market value of outstanding debt, and RB is the return to bondholders. So this is going to be the yield, right, to maturity on debt. So you have to remember all the stuff from the beginning to do this, to solve problems in this unit or module. All right, so an all equity firm has only shareholders. So their relative proportion of stock, where the value of the firm is S plus B, it's 100% stock financed. A firm that's all debt, that's possible, that only has bondholders, that's 100% debt. That means 0 proportion of stock. And in general, a levered firm has only average investors that have a portion invested in debt and a portion invested in equity that is equal to the exact proportion that the firm has debt and stock outstanding. Debt outstanding and shareholder equity. So you see, the average investor acts like the firm acts. So these are all the assumptions inherent in what I'm going to do next. All right. An all equity firm has only shareholders. So the return to assets, the return to the average investor in the firm, since they're all shareholders, would just be the return to equity. If a firm is only financed by debt, then the return to assets would just be the return to bondholders, because the firm is only financed by debt. However, if it's somewhere in between and a firm is levered, so it has both shareholders and bondholders, then the return to assets we call the return to the weighted average cost of capital. So the weighted average cost of capital is the return to the average investor. The required rate of return of the average investor in the levered firm is the cost of capital of the levered firm, or the WACC. Okay, so those all mean the same thing. Weighted average cost of capital. So what is the weighted average cost of capital? Again, we're always bringing up statistics. I assume you know statistics because we've done this already. This is the weighted average. In general, the return on a portfolio, I'm going to use this notation, this is expected return, is the weighted average of the assets in the portfolio. So if you have n assets, you would have this formula. So this is just the expected return for a portfolio as a weighted average. So let's use that concept for the two assets, the asset class of the risky assets, stock, and the risk-free. It's not risk-free, but this is, sorry, don't confuse you. This is the equity, and this is the debt. Let's be clear. That's different than the risk-free. So this is the weighted average because this is the weight on equity, the proportion invested in equity. And this is the proportion invested in debt. So this is the return for why is this the return? What is this all about here? Why am I writing RS for this asset class, but I'm writing RB1 minus TC for the debt portion? It's all explained below, but can somebody explain that to me? So weighted average cost of capital is the return, the required rate of return of the average investor in the firm. But it is also what the firm pays out. For every dollar invested to the average investor in the firm. The fact is, from the firm perspective, so I can just flip this, looking at this from the firm's perspective, which is also, feeds back into the required rate for the investor in the firm. Ooh, what did I just do? Because debt is debt, interest on debt payments, or let's say interest payments made to debt holders or bond holders, is tax deductible. So it's seen as an expense for the firm. The full price, so this represents for every dollar invested in debt, this is the return, right? This is the return per dollar. But from the firm perspective, there's a tax savings because of that. So we're not paying the full amount, we're paying the after-tax amount. So that's what this is. So that's the after-tax cost of debt that goes here. So this is smaller. Basically, this is a smaller number because payments to bondholders, interest payments, has tax savings in the amount of TCRB for every dollar. It's like a tax shield of debt. Which we write as this amount. Okay, so it's not just RB. We get to this tax savings, so we write RB after tax. Okay, so you should be familiar with this 1 minus TC. It's the after tax notation. So everybody should be happy with this. You've seen this. Most of you should have seen this before. And this is both the return to the required rate of return to the average investor in the firm. And because of that, this is the cost of capital. This is the cost of financing or the cost of borrowing on average
for the firm. Any questions? So we've just talked about return. On the flip side, or related or traced through the SML, we have the beta of assets. Beta is also, you could also calculate the risk of a portfolio as a weighted beta. So we talked about that already. You've solved problems with that. And this all happens because the relationship, the capital asset pricing model between return and risk is all on a line. Okay, so you can find the beta as a weighted average of any set of assets. We're only looking at two. We're looking at equity and debt. In this case, we just have the two. So the beta of assets in the firm would just be the weighted beta of the two. Be careful that you are working with the same betas on both sides when it comes to debt. I'm going to stress that we work with the after-tax betas of debt to get the after-tax beta of assets. Okay, so in this way, the beta can trace to the required rate of return for the firm, to the WACC. These both have to be after tax. If you were to do algebra, thinking, remembering debt is not, it's not like T-bills where T-bills has zero risk, okay, but it's low, okay. Relatively speaking, the beta of debt will be lower than the beta of equity. So we'll just say close to zero. If it was close to zero, this term drops out. So you say this whole thing becomes zero, and you're just left with this. Algebraically, if I was to solve this, it demonstrates that because this is greater, this numerator is greater than the denominator, it implies that the beta of equity will always be greater than the beta of assets. So, you see that over here as well. If you realize the beta of debt will always be lower than the beta of equity, what you're doing is weighing down the risk by mixing in debt with equity. Okay, this will weigh down the beta of assets, so it will be smaller than just the beta of equity. So it's a less risky venture to include debt, as long as, that's only if the beta of debt is low. We're going to, well, I don't know. We'll see what kind of time we have here. We have an hour left. I think what I'm going to do is, well, let me tell you when we get to the end. Let's get to the end and I'll tell you what I require of you. All right. So back to the URK, so we can put numbers to all of this. And I should credit you guys. You don't really complain too much. You guys do your work. I'm very happy that that you're getting through this course without asking me for too much. But please, in the next few weeks, we have a couple more weeks. Please keep in touch with me about your progress with this last set of material, and I can offer some sessions if that helps. Okay. I think it's straightforward. It's just algebra. Maybe, just don't slow down your pace of studying for the material and you should be just fine. It's nothing too hard because, like I say, it should be mostly review. So what we have here, from the Bahamas project UR case, assuming the project has the same beta and financial leverage as the whole firm, and compute the firm's WACC. So we're going to take the proportions that the firm uses and use them, like the proportions of debt and equity, and apply them to the UR case, imagining that they borrow just as much for the UR project as they do in the firm at large, okay, because the firm has other projects ongoing. So that's why we borrow these values to calculate the WACC. And now the firm, as a leveraged firm, not just equity, you see the 5% that we had before is higher than including or making consideration for the fact that it's also a debt finance firm. So the required rate of return goes down slightly. The project is still, you still should invest because the required rate return is so low, and the project cash flows didn't change. I won't change those, and you'll see you still should invest, right? Because the IRR didn't change. It's still 10.26. You could calculate the NPV again and just follow the directions. If I don't tell you which one to calculate, just answer the question, show me your work. This should be fine, or this should be fine. This looks like a longer thing to write out, right? So we all really like the IRR. It's less writing, but use it properly, please. All right, so any questions so far? So now we have a fourth calculation. This is taking consideration the firm is not all equity firm. There actually is debt financing by the firm, which we incorporate into our computation of the required rate of return, and it has gone down. Our decision doesn't change, however. All right, we're almost done here. Now, what if it is determined that the project for UR, the Bahamas project, and the firm, the UR firm, have different betas. Okay, so let's say the project is more risky. The project and the firm are not from the same line of business, so we don't have any information directly from the business to use. We should actually go to industry and see what how other firms flying to the Bahamas are doing, and we use that to recalculate our required rate of return. Now this is hard if you have a startup company and you don't have industry data, and you would have to use maybe a range of different betas to make your calculations, okay? You were doing this in practice. If it's determined that the project's just risky, more risky than you've seen in industry, or more risky than historically the firm, than historical projects of the firm, you do the same thing. You get a range of betas and work with them to recalculate and see if your decision is reasonable. Now here, let's say it was determined, considering the industry, considering other competitive firms, it was determined that Bahamas Line has a beta of 5.5. This is much higher. Now, let's go back and recalculate everything using the new beta with the historical market risk premium from the last 6 years and look at what we get. It went up quite a bit. So this is the new required rate of return for equity. So this is the equity. This is the return on equity, right? This is the return. I'll just write it here just so don't get confused. So this is like the RS. This is the return to equity. But now, because it's a levered firm, we have to calculate the WACC. That's the most meaningful for the firm investors. So to do the WACC, we put all these numbers in. This is the one we just calculated. This is the weighted. So I give you all these numbers. This is the proportion invested in equity by the average investor and by the firm. This is the proportion financed by equity. And this is the financing by debt. These are all the numbers we use. And now what happens is, so this is like the 5th calculation of CAPM. So now that is too high, isn't it? The required rate of return is higher than the internal rate of return, so we should not invest in this project. Any questions? So you see all the different variables, all the different assumptions that go into this. You would have to have different spreadsheets and keep track, maybe a range of values. And to determine, up until this moment, we agreed that UAir Bahamas project was worth it. But now suddenly when we change the beta, it throws the project under the bus. It's just not worth it. So you could reconsider that beta, maybe find a threshold, what's the most the beta should be in order to accept the project, and then consider if that's reasonable. Okay, you can make calculations like that. Okay, so now I have this question for you. The T-bill rate currently, if we're going to use this approach, the current T-bill rate is quite low on investment decisions. What is the effect of increasingly low T-bill rates on investment decisions? So when you think about it, you want to think about the effect of the T-bill rate at this point, right? It's going to affect how you calculate the equity, return on equity. The current T-bill rate being low makes it, like if it was even lower than this, it's 1%. If I put a negative in there or a fraction of 1%, this goes even lower. So your required rate of return falls. So what it does when your required rate of return falls, it makes it more likely to accept projects. And that's the stimulus effect of low interest rates, low T-bill rate as the progenitor, or the, it determines all the other rates. In the economy. Okay, so that's all I'm going to say here. Are you guys asking me something? I don't know what you mean, Ariette. This is not different from what we did before. It's just adding in debt. The only, you mean for the, I'm not sure about the question. Entonces, mejor dejamos llevar por este medio de cálculo en vez de los que hicimos anteriormente. What do you mean, anteriormente? I'm sorry, I'm making you. I appreciate all the questions. So
So this is just all that I've done now is added in. So this is the CAPM that we've used. The alternative is the dividend growth model. I've given you the examples. All that I've done today is introduced debt financing and WACC. So what if you have another asset class? What if you have preferred stock? Preferred stock pays a constant dividend in perpetuity. So what if a firm issued stock, preferred stock, so common stock, preferred stock, and debt? Well, then you have to include in your calculation of WACC, you have to allot for the preferred stock as another portion. And the value of the firm includes all three outstanding. So I gave you a lot of examples of this. What I can do, I guess I can refer you to video to see all those calculations if you're having trouble, because I do make a lot of these. I do some of these calculations, but I do want to talk about the next material because we do have an hour. Okay, Ariette, all that's different between this and the second exam, the only difference is that you are calculating the required rate of return. You're not using the one I gave you. You're getting it yourself. That's the difference between what we did before. So you're first, like you're doing the same thing, NPV, IRR, but this discount rate, you found it yourself. That's the difference. Okay, yes, it's all coming together. It's good questions because I know it's going to click. So this is the same things we did before. All I've done is forced you to calculate R now. That's what you're doing. Okay, let's not lose sight. And it's very risky because I know we do a lot. We go very deep, but don't lose, pull out and look at the big picture. This is where we got. All right, so there's several problems. What I'll do, let's just leave it there. You guys work with that because, like I said, most of you should have seen WACC before. So I will leave you with all the exercises. I know next class is another class for you, but I will make a video anyways, and you guys can review it, okay, on next Friday. I have it in my schedule, so I can do these problems. So email me any problems you want to see me solve. That would be the best way to deal with this situation. But I want you to start delving into it and see where you get stuck because you have all the solutions. Do your best to work through it and let me know if there's any problems you want me to work out. For instance, this last one, I give you a problem like this, and there might be a few places where you question what is going on. So if I can help you with that, it's my pleasure. Okay? So let's get to the last bit, and let's see how far we get in the last bit of stuff. So I can feel... So let me tell you something, because maybe you're a bit freaked out. Let me write something here. Okay, so this is going to be on the test. I don't know what this is asking me to do. I think because it has a signal for another monitor. All right. You guys have many assignments in Connect. What I did was put a final assignment with a bunch of stuff in there, things that are for self-study. And what I'm going to tell you I made it due before the final test.
that is what I'm going to do is grade you, because there were five assignments, right? So I
think it's 5. Anyway, what I'm going to do is drop your worst assignment.
I'm going to drop your worst assignment. So for people who missed an assignment, so anyone who missed an assignment, you don't have to do the last one, but I recommend you do it because it's excellent and it's comprehensive and you'll have all the material from the class. But for people who have done everything and they did well enough and they don't want to do the last assignment, that's fine with me. So this is an opportunity for you to make up for a bad assignment or a missed assignment, and I'm rewarding people who have done everything consistently till now. And those people will probably want to do this last assignment anyway, so there you go. Okay, so I'm going to drop the worst assignment. Okay. So let's do the last bit of stuff. Do not know why it's showing me that. So the question becomes, what is the optimal amount of leverage a firm should have? That's what the question, that's what becomes the question here. Because we were working, we learned how to work to figure out the expected return for a firm with debt, a firm with equity.
Why is this off center? Hold on a second. I don't know what's happening here.
So what is there an optimal capital structure? Is there a preferred level of debt and equity?
So it comes down to 2 questions, and then really ultimately we're going to ask the question about, is there an optimal level of debt?
Should management aim at maximizing the value of the firm or shareholder equity? That's the first question. Which one should the firm be interested in? Does the value of outstanding stock pretty much... So should firms be, cater to shareholders? Is that enough to increase the value of the firm? That's what we're looking at. And second, what is the optimal level of debt, or the debt to equity ratio that will maximize that shareholder equity? Because in the first question, we're going to conclude that if you care about the value of the firm, then you have to care about shareholder equity. All right, so this is the theory of Modigliani-Miller that will get us there. I begin with demonstrating how to think through this problem. There's like nobody here, but whoever's here, I will give you the information. Hold on, I'm just checking. I see a message. Okay. Okay, so I'll give you the best explanation I can. So this is 6.1, M&M. So what we have here in this chart, and for answering question 1, what we have here are 3 scenarios if a firm goes from a all equity firm to a debt or a levered firm. So unlevered, that's the U, so this is a firm with just equity. The value of the firm is $1,000. With no debt. So since the value of the firm is 1,000, you can think of these as millions if you want, or in thousands of thousands. But the point is that this is the value of equity, right? Because V is equal to S plus B. And we just have S. If there's 100 shares, that means the stock price is $10 per share. Everybody okay with those calculations? Okay. So now, in order to issue debt, this is achieved by borrowing $500 and distributing the proceeds to the shareholders. So this is a direct redistribution. You can think of it as paying them off to accept the debt issue, if you like. And what happens? Okay, so if that money goes directly into their pocket, what happens? This is the original case. The value of the firm was was 1,000. Debt was 0. The shareholder equity was 1,000. Okay. And the value of the firm is $1,000. So we're going to think of 3 different alternatives, either in the best state of the world, the worst state of the world, or nothing changes. In the best case, $500 is borrowed, so the debt outstanding is $500. And the perception of shareholders is that their value, the value of equity, goes to $750. This comes directly from this equation where, keep in mind, value is equal to S plus B. So the value of the firm with debt now minus the value of debt is equal to the value of equity outstanding now. So where does this come from? Let's look at the payoffs to shareholders. The dividends in total are $500.
after the restructure. Okay, so we're restructuring the firm. There's a loss, a capital loss in the value of stock outstanding. So the payoff to shareholders from this restructure is $250. So that's where that 750. So it went from, the 1,000 capital gains. It's a loss of 250 for a total firm value, if you were to add these two, of 1,250. What if nothing changes? What if the perception of stockholders, prospective stockholders, the value of the firm, the value of equity outstanding is 500, where debt was 500 because 500 was borrowed. The value of the firm didn't change, so the outstanding equity, or the shareholder equity, is 500. And the worst case scenario, where the value of the firm actually drops to 750. This would be achieved by shareholder equity dropping to 250. Okay, so you have the best, the same, and the worst case scenario, where I figure out the shareholder equity as a difference from this to this. And you can think of all the cases in between, but I've done some extremes: best, worst, and same. So in the first case, as I showed you, the payoff to shareholders is 250. In the case where nothing changes, there's no change in shareholder equity. Payoff, because the capital gains is a loss of 500 from the effect on shareholders' equity, but the dividend is 500, so it's a net out, no change. Okay, and then here, in the worst case scenario, where the value of the firm drops, this affects the capital gains, a loss of 750 here. Dividends are still 500. Dividends are always 500. And there's a negative payout. So what you see, what is the conclusion here of this table and these considerations? It's a very simple example showing you whatever happens to the value of the firm happens to this shareholder. So the value goes down, payoffs to shareholders goes down. Value of the firm goes up, payoff to shareholder is positive. Nothing changes for the shareholder. So when the value of the firm is high, so is the value of shareholders. Shareholders should be concerned with the firm's value. And in turn, the firm value directly impacts shareholder equity. So think about that. Any questions? So this is the main conclusion of this chart. All right, so given that, is there a way to increase the value of the pie, the V, is there an optimal capital structure? So M&M, Modigliani, and Miller are the seminal theorists on this topic of what's called capital structure, relative proportions of debt and equity financing. Now, like any model, there's a load of assumptions, and I'm going to outline the most important ones for you to know before I continue, okay? So that you can
realize I'm going to relax the assumptions and we're going to have different results. So the question is there an optimal capital structure? Is there a way to maximize the value of the firm by choosing the right amount of debt and equity mix? So can I make the pie overall larger that we saw on the first page? Well, they say if the following assumptions are made, the firm value is not affected by financial leverage. So if you assume something like, you can think about this. There's no effect. Nothing changes. So you can think about that as an example in your mind. So the assumptions are the more debt is issued, there's no increased risk of default. So if the firm continues to borrow or borrows beyond expectations, no problem, no risk of default. So that's a stretch of an assumption, but that's how we get this result. So we have to assume no risk of default. We're going to assume, to make some calculations, that cash flows are perpetual. It means, it's a steady cash flow and it's a set amount indefinitely, so forever, because the firm theoretically can outlive its owners because they can sell or bequeath their ownership. And firms and investors can borrow and lend at the same rate, which is also a stretch of an assumption. Also, this one is a stretch because we're assuming we know what the perpetual cash flow is and it stays the same. And then this other assumption is firms and investors can borrow and lend at the same rate, saying that someone borrowing money, an individual, and a bank who lends can borrow and lend at the same rate. We know that's not true, but we need that assumption as well. And we're also going to put in the assumption of no taxes because we understand there is a benefit from a firm perspective. There's a benefit to issuing debt, right? Because they experience a tax shield or tax savings. So we're going to remove that benefit and say there's no taxes. So there's no advantage from issuing debt over equity. So with these results, with these assumptions, the result is that the firm value is not affected by financial leverage. Okay? So for example, consider this data here. These two firms are identical in every way except that one is levered and the other is all equity. So we have levered here and the all equity unlevered here. So assets is equal to equity with no debt. Got it? So the U is just for the firm that's all equity. Sometimes we just use an S rather than U, but this is just to stress that I'm comparing it to the levered firm here. So the levered firm is going to be is going to have $400,000 of debt with a return to debt holders or bondholders of 5%. Sorry, the question was about tax savings. About here, right? We're saying there's no taxes because there is a benefit. There's an incentive for firms to borrow money because they realize the benefits of the additional financing at a lower cost than actually issuing stock, right? Because they, with no risk of default either, they are getting tax savings. So I'm removing that. There's no taxes, so there's not that additional incentive to debt. Anyway, you'll get it when I put it back in, if not already. All right, so
Remember, firms and investors can borrow and lend at the same rate, and there are no taxes. So what happens? If we assume that
My voice is going. Hold on, let me drink something.
okay, if we assume, or I introduce that the dollar return on firms' assets is given as Y. It's not known, so I'm just going to call it Y. So now a new table. Here's a new table. So an investor, a prospective investor, looking at investing in either of those firms could adopt a number of strategies and just consider two. Strategy A is buying 10% of the levered firm. So the dollar investment of the investor is 10% of this, right? Because the value of the levered minus the debt is the shareholder's equity. So he'll be invested at 10% of the stock. The dollar return to investors would be, remember the Y I talked about, these are the revenues of the firm or profit. Well, no, because then I'm going to take off this. So this is the revenue from the firm, and this is the cost, right? Because they have to pay bondholders for every dollar invested. So B is the dollars invested, or the dollars invested, and this is the return to bondholders. So they have to pay this. That leaves the net amount. So I put some numbers in here just so you can see them. And this investor in strategy A investing in this levered firm is going to get 10% of that. So they're invested 10% of stock. So their value is 10% of the value of the dollar return. So I've made some calculations here. I've shown you here. This is the dollar investment. This is the dollar return. So that's for investors in the levered firm. Investors in the unlevered firm could achieve the same payout by doing this. By buying 10% of the value in the unlevered firm but borrowing 10% of the equivalent value of the debt outstanding to firm that's levered. So they can create the debt because of their ability to borrow and lend at the same rate as the firm. They are like creating it for themselves. So it's possible with the assumptions given. They buy 10% of VU. This is the dollar investment. They borrow 10% of the value BL for this total dollar investment. The dollar return would be 10% of the firm's value, or the returns to the firm. There's no payouts to bondholders in this case because it's an unlevered firm. But then they have to pay for borrowing. They'll have to pay this 10% of BL. This is the interest rate that they have to pay back. Okay? And when I put all this together, this ends up
this is just 2,000, a negative 2,000. So that's the return, that's the cost. And so you have the same dollar return in strategy B, investing in the unlevered firm and borrowing at the rate, borrowing on their own account, or investing in the levered firm. So they create the same dollar return. So the dollar returns from the strategies A and B are identical. That means that the initial cost of both strategies must also be identical, since there are no arbitrage opportunities in an efficient market. I sent you, I asked you to read the efficient market hypothesis notes for self-study, but essentially there should be no arbitrage opportunities in efficient markets. It's another assumption. Always make the assumption in finance markets are efficient, or they market clear, or there's no opportunity. So we talked about that with the SML last time we met, where I was talking about how adjustments are made to rule out any profits or opportunities, right? All information is calculated into the value, price of assets. Okay, so you guys can rewatch this video and it'll make more sense once you work through this, the exercises I've given and read the textbook. All right, so that means the value of the levered and the unlevered firm must be identical, because I'm going to equate these, and the only way these are the same is if levered there's a typo here. That has to be a U. So I need to equate this and this. So this is a U here. How did that happen? So from strategy A, this is strategy B. The result is with the U. This is a U here. Okay? So that means for those things to be equal, these two must be equal. And what does it mean? It means that leverage does not affect the value of the firm. So adding debt does not affect the value, and it doesn't affect shareholders' equity. So with the firm preoccupied with maximizing shareholder value, it just turns out in this case that the amount of debt doesn't have an impact on that. Okay? So starting from there, I will remove some of the assumptions and you'll see the impacts of the assumptions changing. So what we have here is we're going to see this chart again and again. There's the debt to equity ratio on this axis, and the value of the firm on the vertical axis. And no matter how much debt is issued, the value of the firm stays constant. That's known as M&M Proposition 1 with no corporate taxes. Now on the inside of that, we look at the value of the firm and we consider the required rate to investors in the firm, right? The weighted average cost of capital to a firm, to investors in the firm. Weighted average cost of capital, what is paid out to the average investor in the firm. And here it is. Because Proposition 1, because of Proposition 1, the WACC must be constant as well. Here's the WACC. Here's WACC is right, return to equity, return to debt. Now I took out taxes. There are no taxes, so I don't have to add that after-tax term here. So RU is the return to investors in the unlevered firm is equal to the WACC. So this is just showing the return to investors. WACC is for the levered firm, right? So this is like, this should be RL, but it turns out this must be the same because the value is the same. Sorry. I'll leave it there like that. Right, because this is for the levered firm. But it must be equal to the unlevered firm because the value of the firm is the same. So taking this part of the expression and solving for this return to equity. So stockholders, let's look at the effect on stockholders. If you take this and you rearrange this, you get this expression. What does it show you? It shows you where RU is the risk inherent in the firm's operations. This is dependent on the beta of assets in the unlevered firm. This will always be positive, right? Return to debt is always going to be lower than the return to the firm that's unlevered, because we discussed that already, right? This will be the return to debt will be relatively smaller. That's the idea of including it in the levered firm and reducing the overall required rate of return. It weighs it down. So this is always going to be a positive. So what this is saying is, since this is always going to be a positive, as you increase the debt to equity ratio, so the more debt you add, so as this increases, this will always be positive. Well, I should use a different color. And this increases, it means that the return to equity will always go up. It's increasing with the level of debt. So what is this saying? As shareholders will require a higher and higher level of return for the greater level of debt. So that looks like in this same graphic, the return to debt is always the same no matter the debt to equity ratio because the no default risk assumption. So there's no reason why a higher level of return will be required if there's no default risk. We already explained that the WACC, which is RL, but I write it WACC because that's what it is equal to RU. But to keep this all together, the required rate of return to shareholders is always increasing for the level of debt. So this is the
map of the cost of equity, the cost of debt, and the weighted average cost of capital that comprise what's known as M&M Proposition 2 with no corporate taxes. Now, what I'm going to do is introduce taxes. And let's see what happens. So I'm just going to introduce taxes. I'm going to give you some information here. So what happens with taxes? Again, cash flows are perpetual. Okay, so we make that assumption. We're not going to include any considerations of depreciation, or that like nothing depreciates is our assumption. And there's no fixed asset or net working capital spending. So here we have a simple example where we have a firm considering going from zero debt to $400 of debt at 10% return or yield. So for the unlevered firm, imagine the earnings before income, interest, and taxes is 200. And it's the same for the levered firm. So we're not going to change the earnings. Now, in this case, there's no debt to pay, but here you have to make $40 interest payments because 10% of 400, right? And then taxes would be 40% of 200 here, but because taxes are net of interest payments, you get, this is tax deductible, it's only $64. So see the tax savings right there, okay? Because this is tax deductible. So I don't include any other kinds of considerations to make this, as simple calculation as possible to make the point. So the net income here is 120. Here it's 96. But in terms of cash flow, don't forget, we have to include the tax savings. So we what is that? This tax savings is calculated just like what we've done before with the tax shields, right? Similar to the tax shield. Where I've already made this calculation here. This is $40, and then I multiply by the corporate tax rate. So it's $16 tax savings.
So what do I do with all this? Since interest creates a tax deduction, borrowing creates an interest tax shield. This value is added to the value of the firm in perpetuity. So this additional value, where I take $16 in perpetuity, is really $160. In general, what I've done is TC times RB times B, right? Because I did that already. So this is in general, this is the calculation in perpetuity. So at its discount rate. So overall, since I take that as perpetual cash flow, it's going to be future cash flows at the rate of RB, its required rate of return. So this term is added to the value of the unlevered firm. So this is the new value of the firm. The value of the firm is affected by the fact that there's taxes and there's tax savings that are perpetual. So this extra term gets added as a result. So the value of the firm goes up and it has no end, does it? You could increase indefinitely the value of the firm because we still assumed default risk was 0. So this is an extreme example because we made extreme assumptions, but it demonstrates that untethered, the value of the firm could just be increased by issuing debt. So we call this the present value of the tax shield on debt. So now we have, this is where the levered and unlevered are together. So this is without taxes, and now this is with taxes. Put them all in one graph. Let me improve that. So this is without taxes, and this is with taxes. So there's a tax incentive to debt. Okay, I'll answer the question at the end because time is up. Oh, I need to finish. I'm going to finish. I'm going to finish. If you have to go, go ahead. I'm going to finish this. Okay? I just have a few more slides. So for those who have to go, I will talk to you, keep in touch, and I will broadcast next week with problems that you can review for your study purposes. But I'm going to finish these notes right now. All right, so notice that on this axis, I put debt, not the debt to equity ratio, right? Because I wanted it to be matched with this here. Let's do an exercise. Let's see. Earnings before interest and taxes are 100. Corporate tax rate is 30%, and the required rate of return, or this is the cost of equity, that's for the unlevered firm, right, is 12.5%. So if debt goes from 0 to $100 at 10%, what happens to the equity value, S? Remembering that
S plus B is equal to V, let's calculate the value of the unlevered firm. Let's get the new value for the levered firm using the formula that we just learned. And then we can calculate the new equity shareholder value. All right. So we begin with using earnings, perpetual, right? So this goes on indefinitely. So we use the perpetuity formula. There's taxes, so that I have to consider after tax. And this is the required rate of return. So let's see. So this is really, it's bringing everything together. So earnings 100, 0.7 over 0.125. And when you get it, it's 560. The value of the levered firm using the formula is the value of the unlevered plus TCB, which was derived earlier. So that's going to be 560 plus 0.3 times B, which is 100. So the new value would be 590. And finally, now we can calculate the shareholder equity, and we see shareholder value for the levered firm given these data points, these values, it looks like shareholder equity went from 560 to 490, right? Because this was an all equity firm. And now this is a levered firm. But the value of the firm increased. Since shareholders care about the value of the firm, they are what? Let's see. So let's look at the return, the required rate of return to shareholders. Okay. So what is that? That's RL, required rate of return, of the cost of equity in the levered firm. Here's the WACC formula. I'm adding in after-tax amounts. And we will conduct the algebra to solve for this. So what I'm solving is a return to shareholders. So this looks familiar. We already saw this, but we're adding in this extra term here. So we're going to calculate now the return to shareholders . Sorry, what are you guys talking about? B equals EBIT. No, B is one. Yeah, it just happened to be that way. But B is
That's not, it's just that B is equal to 100. That's what it says here. All right. So let's make these calculations. The return to shareholders in the unlevered firm was, go back, 12.5%. So that was 12.5%. RB is the return to debt, and that was, we said, 10%. The debt was 100, and shareholder equity is 490. And I should say, yeah, so we did already figure that out. So it's 590, right? And then 1 minus TC is going to be 0.7 because TC was 30%. Sorry, I'm flashing back and forth. Okay. So the return to equity, what happened to it? You guys get that number? So it's 12. It's gone up anyway. It's 12.86. I'll just keep all the decimal places. All right, now remembering the WACC. Let's use the WACC formula here. Let's put this together. I'll use all the numbers we're used to. So S for the levered firm now is 490 over 590 for the value of the firm. RS is this one. You can store that value, 12857 1429. You should store it. I should make a note. Store 1, and then recall it here, and then add 100 over 590. I don't have a lot of room here. Sorry. 10%, and then 0.7 for after tax. Oops. I make any movement and I flipped it. Okay, so when you put all this together, what do you get? Now you can do this in Excel, it's fine, but you have to write out your expression on your, well actually no, it's going to be, the final test will just be multiple choice, so you don't have to show me anything. But it would be good to try and keep yourself, keep things neat and tidy. I can allow you can send in your solutions in case you want to argue some calculation with me. I'll allow you to send in your solutions. So keep your things neat and tidy. What do you get? You got a different number? I'm going to try again.
Okay, I still get the same number. And then I store it. And I calculate 490 divided by 590 times recall 1. And store that in 2. And then 100 divided by 590 times 0.1 times 0.7 equals plus recall 2. And yeah, that's what I get. Okay. So what happened? The return to shareholders in the levered firm, the required rate of return goes up. It was 12.5. It goes up to 12.85. So they required a higher level rate of return in order to take on debt holders. And from the average investor's perspective, the debt weighs down the required rate of return because debt has no default risk and all of that. And it's a lower rate of required rate of return. So it weighs this down. It goes down below the original 12.5% for an all equity finance firm's investor who's just a stockholder. Okay, so that's what happens here. What does this look like? That's just a numeric example. The WACC decreases as more debt financing is used. Since WACC is a discount rate for all future cash flows, the optimal capital structure is all debt. So what you see here is that the firm is incentivized to become an all debt firm. So investors who are shareholders actually look more and more like bondholders, and the firm becomes all debt financed. Okay, so it crowds out the shareholders. So this is unlevered return. This is with leverage. But then simultaneously we have this happening where the average investor is becoming really a bondholder. So their required rate of return is going to be bounded by the return to shareholders per dollar invested, because all investors will become will be bondholders because the ultimate decision is an all debt financed firm. So all of this was possible. So the conclusion is the value of the firm could be indefinitely increased by taking on indefinite or all debt. And investors just look like bondholders with their required rate of return. So to have a different result, I have to introduce default risk, which is very realistic. At some point, taking an indefinite amount of debt to realize a higher value for the firm can only be, it has its limits, okay? It has its limits. So what we have is for M&M with taxes, this result where debt provides tax benefit to the firm should borrow an infinite amount. But the reality is the firm has to pay interest and principal to bondholders. If the firm defaults on a payment to its bondholders, it will enter a phase of financial distress. Or ultimately, if financial distress persists, the firm will declare bankruptcy. There are costs involved in both financial distress before the bankruptcy and after the bankruptcy. There are. Okay, I'm glad you got the calculations. Very good. There are the direct costs. The legal and administrative costs of hiring experts to help restructure, to reassure investors so they don't sell your stock, reduce the value of the stock outstanding, and make it impossible to raise financing through stock issue. So these are going to affect the operations of the firm indirectly. The fact that the firm is in financial distress, bankruptcy will actually create all sort of legal and administrative costs. So indirect costs would be the impacts or impairs the ability to conduct business. So customers who are loyal customers will feel the uncertainty of buying products from a company that might be going bankrupt. They'll lose their warranties, for instance. And they worry about the quality of future relationship and the stability of the future relationship. So they look for other suppliers or vendors or collaborators. Their agency costs, where stockholders may engage in the incentive to take larger risks, so in an all or nothing approach. They might have incentive to not take reasonable risks because they're investing or choosing to invest in larger risks. There may be the selfish strategy of liquidating assets and payouts to managers to incentivize them to favor the shareholders, because in the end, the fact is that creditors have a right through their bond certificate, through their indenture, they have a right to their interest payments. So they can, as a group, take the firm to court and force them to pay. So where does that leave the shareholders? The shareholders may engage in these selfish strategies to get something for their stock before the value of their stock falls out to nothing, and they're just holding a worthless share before the company goes bust. All right, because with all these added costs and the loss of reputation, who's going to invest in this company? All right, so these are the realities of and the limit, creating a limit to the amount of debt issued. So what does this do? Effectively this offsets the benefits to adding debt. At some point, we have to consider the cost of financial distress and potential bankruptcy. So that has to this has to go into our valuation formula as well. So we have to subtract the present value of expected costs of financial distress. For firms with low financial leverage, the probability of default is close to zero. So this number is zero, and this general formula just reduces to the one we had so far. So a $1 increase in debt will increase tax benefits and the firm value at a constant rate, TC. So you just end up with this part of the formula. For highly levered firms, the probability of default is positive, and a $1 increase in debt will increase tax benefit at a constant rate C, but it will also be offset by increased costs of financial distress. So the conclusion is we increase debt as long as tax benefits exceed the present value of the cost of financial distress. And if we can find that optimal level of debt, that's the one we should pick. So here we have an example of what that might look like. And I'm seriously almost done here. Can you find this here. You see, this is the value of the firm without consideration of financial distress. This graph here shows the effect of financial distress where the value starts to fall. If we can find this, we benefit from the incentive of tax-deductible interest payments, but beyond that, we shouldn't take on any additional debt. So what is B star? How do we find B star? And again, remember this is on the graph with B here. Well, if we could estimate this as a formula, we could use calculus to find the maximum. Now, I'm not going to do that in this course at this point in time, but you should be able to do that with your understanding of calculus. If I gave you a formula, you should be able to solve for the maximum there. That's not a lot to ask, but I won't ask it just because we're at the end of the term and I don't have a lot of time to review that with people. But that's what you could do. What happens to the required rate of return? We need an adjustment here for the WACC. This is the return to investors that are shareholders. This is the return to bondholders. And this is the premium that must be paid for the cost of financial distress. In fact, the average investor in the firm needs to be compensated for the risk of default. So that's what it would look like, where you have, this is when there's the case of no taxes. This is with taxes, but no default risk. This is showing you the average investor in the firm requiring, after this or beyond this optimal leverage ratio, they're requiring a higher level of return. And the more debt issued, again, the average investor becomes a bondholder, right? If you have more and more debt, so these will converge, the WACC and the return to bondholders. So that explains the patterns that you have here. There is a minimum cost of capital that is matched right here is where the optimal level of debt, or here we have it as a debt to equity ratio. This is the optimal level of debt, which is also the minimum cost of capital. So those are all the notes. I gave you a number of exercises to work with. I gave you all the solutions, and you have 2 weeks to work through that. So pace yourself, keep me posted, and I can solve some of the problems online either in office hours. Also, I can wait till Friday, but if you ask me before Friday, I will post a video for you. All right, do you have any questions right now? I can stick around if you have to go, get going. Otherwise, it's a pleasure to have taught you this class, even if it was at distance. I believe we got through all the material. I believe you learned something. You can let me know if you have any concerns before the test, and I'll do my best to alleviate your concerns. Okay, bye to those who have to go. And those who are still here, if you have a question, let me know.